far, one of the theme which is there in the global markets for the last 1.5 years is basically the inflation fighting, right? I mean, inflation was there nowhere when the countries had zero interest rates and negative interest rates, but then inflation came and then the inflation fighting began by all the central banks. Last 1.5 year has been a situation where central banks have been hiking rates constantly to fight inflation, and inflations were there in almost every country. As you can see in the right colorful chart, every country had inflation, and now everywhere it is coming down. The question is, has it come down sufficiently? So yesterday the FOMC was there, so that way today is a very pertinent day for having this webinar where we will be discussing what is the path forward.
Just quickly, the inflation trajectory, if you see US, if you see most of the countries, it's coming down. But the problem that is facing central banks is that while inflation on the headline basis is coming down, the core inflation, which is basically the sticky inflation which they track, that is not coming through as low as they want it to be. So for example, in the US, the core inflation continues to be at 5.3%, despite the headline being 4. So while markets were expecting that the Fed will therefore consider the falling inflation trend, the core inflation being sticky is something which Fed doesn't want it to just go by, and they want to make sure that that core inflation part settles down. So this is the context basically. Because we are discussing Euribor, even with Euro area inflation, the last print was pretty low, rather low compared to the previous month. But that said, it is still very high. So the point is, inflation is coming down, but still way to go. So that is important to understand the general yields and the rate hike side. So now what has happened is, markets were actually for example, especially in dollar SOFR curve, 2 months ago, they were expecting 2 to 3 cuts this year. Now, right now, even day before yesterday, they were expecting 1 cut. But yesterday, Fed clearly communicated that inflation is definitely sticky. So they don't expect any cuts this year, right now. But then they do look at an aggressive rate cut cycle starting somewhere in December, Jan of next year, rather December of this year or Jan of next year, with almost 5.3% peak coming down to 3.5%, right? Which is basically to say that roughly you can talk about, let's say 1.3 plus 190 basis points, almost 2%, almost cuts. So this is a very aggressive cuts in the next 2 years. No, this is what markets are expecting. But we think that the Federal Reserve will continue to do what it wants to do, meaning as long as there's no market panic, they will keep holding rates and even hike a couple of times, as what they are communicating in their dot plots. So they want to hike 2 times and then hold it for longer, meaning what is going to happen is this curve, which is downward trending in the next 2 years, we think that it will continue to be high. The interest rates will continue to be high, and suddenly there would be a fall, because by keeping interest rates high, Federal Reserve is also causing risk events like the bank crisis, which has happened 2-3 months ago. The potential for it to again happen is pretty high if interest rates continue to be like this. So the point is, our view remains that inflation being sticky will force the Fed to keep rates as they are, and suddenly one fine day they'll cut drastically. Now, when that would happen is a question which is anybody's guess, but we do think that at least maybe 6 months to a year, nothing will happen. Interest rates will continue to maybe go up from these levels, and suddenly there could be a fall, but the timing is a bit moot according to our view. And also that when Federal Reserve cuts rates, it's not going to be like the way this market is expecting, meaning maybe 530 becoming 350. We don't think that's going to happen. If Federal Reserve is forced to cut rates, they are going to cut very fast and drastically. So that is another factor that we need to consider when evaluating the SOFR curve. Right? And on the Euribor also, the same phenomena is likely to occur in this year, and up to next year, the markets expect a hike, and from then on, there's a gradual reduction, which for an economy which got used to negative interest rates for so many years, this itself is a problem, and there are so many issues in Euro economy because of interest rates that if it starts to panic, I would say the cut from ECB will be much faster. I'm talking about the quantum of cuts. So this is where we stand in terms of the view vis-a-vis the market.
This blue chart which you are seeing for the SOFR, this is today morning after FOMC. These are FRAs. FRAs means if you have a dollar loan, what are the future expected SOFR? Like what will be your fixing, like future LIBOR fixings, This is bootstrapped from the interest rate curve. So this is the way the interest rates were. Our currently market is expecting that this is the way. So if you actually want, you can fix your future FRAs, future SOFRs for your loan at 349, 315, whatever these numbers are, 444. This is what the market is expecting right now. now. Few days back, the expectation was the green line, that the rate cuts will be faster and then they will play it. Maybe, somewhere different, but I just broadly it was lower than the blue line. Now, and we were actually talking about this red line, that it will linger longer. The high rates has to continue for longer term. Market has adjusted itself, but not sufficiently. Still, it is expecting a cut. Not too long, but somewhere around, beginning of the next year. That can happen, certainly, but that will happen if there is a credit crisis, liquidity crisis, recessionary pressure. However, that itself is a turmoil. So a turmoil can only bring a sharp rate cut. So if we are rejoicing for any reason because of the rate cut, we have to always remember that such a rate cut will come after a bad event of a turmoil, whether it's a credit crisis or a liquidity crisis. Just like that, very happily inflation will come down and we will have a cut. It is very unlikely. The soft landing, which Fed's target, that everything is happy, people are happy, inflation slowly coming down, rates again they are adjusting slowly, and we are back to comfortable. Why? We will be discussing in the coming slide. So these are our expectations. Market has adjusted, but not fully, but market has started adjusting. They were not expecting a very rate cut, and the moment they adjust, the moment the blue line is going up, that is stronger for dollar. So yesterday night, before FOMC, dollar rupee reached 81.90 kind of levels, and after the news, it came back to 82.20. Okay, today morning it was at 82.20. After the outcome that Fed will be possibly not be cutting too fast, dollar strength came back.